Hello and welcome to Your Money, Your Call. I'm Kim Slater. If you have a question about shares, our phone lines are open on 1300 30 34 35, or if you prefer, you can email us at yourmoney@skynews.com.au. So, welcome to the program. Tonight I'm joined by Tim Kelley from the Montgomery Fund and Jeremy Hook from TMS Capital. So, gentlemen, today we've seen, a market that's been bouncing all over the place this week. We've had the commencement of the US earnings season. Out of Europe, we're seeing nothing happening. It looks like the process has become elongated there. We've got a lot of expensive defensives in terms of price. The market just seems to be marking time. If you talk to the chartists, they tell us we're going to the moon. We're about to enter a new bull market. But the reality is, we've got to have some pretty solid fundamentals for that. So what are your thoughts of the market at these sorts of prices? Is it expensive? Is it going to run harder? And what are the sectors you've got to be in?
Kim, at the Montgomery Fund, we're always reluctant to express a view on where the market might go in the short term because we simply don't know. To us, in the short term, random chance plays a huge role in determining what happens. Looking longer term, we're not uncomfortable with the market at the current level. To put a bit of context to that, it's probably worth noting that back in 2007, the market was 50% higher than the current level, and while the market was probably stretched back then, it didn't. I don't think many people were saying it was outrageously overvalued. So a pretty unusual set of circumstances 5 years on to have the market still so far below that peak. And we think, looking more broadly, the market is not a long way from fair value, which means that in the long run, if you find the right opportunities, you can expect to do reasonably well being invested at a time like this.
Tim, what are your thoughts? And if you were going into the banks, do you guys have a particular couple of choices in the sector that you prefer?
Mm-hmm. Yeah, Kim, I think there are a couple of things that we like about the banks. One is, as we've mentioned, that they have a pretty strong capital position relative to most of the banks around the world. Secondly, the industry structure in Australia is not a bad one for the banks, particularly in the wake of the GFC, where a lot of the competition was cleaned up or disappeared. You've now got a very strong market position held by each of the big four banks, and that contributes to stability of earnings going forwards. On the downside, or valuation is the first issue. We in the Montgomery Fund have owned Westpac not long ago. We no longer do. The reason for that is that the valuation, we think, has run, or the price has run a little bit ahead of its valuation. And we're concerned that credit growth will be relatively slow in the years ahead, so that growth in earnings, growth in dividends, we think is unlikely to drive them very strongly. At the same time, in a low interest rate environment, you might expect the banks to get a bit of a kick along. But at the moment, we don't see a compelling value in any of the banks, notwithstanding that they are good businesses.
Interesting dichotomy of views there. We could sit here all night and talk about the banks and the argy-bargy. Okay, we'll move to our first caller, who's Murray from Queensland, who's been waiting on patiently. Welcome to the program, Murray.
Thanks for taking my call. Regarding the 10 network, what's a good entry point if you were to buy the stock, and is it a safe buy? Some fundamentals also, and where do you see it in the next say 3 to 6 months in the short term? Thank you.
Interesting question, Murray, because we were talking about this with Tim just before the program started about the valuation that's come through on Channel 9 coming, where the lenders have agreed that I think 2.3 billion is the market value, and Tim, you were saying about 9 times EBITDA. So we'll go to you first of all. How does that valuation on Channel 9? How does that stack up against 10? And what are the implications for it for 10 and probably also, to a lesser extent, 7 West Media?
Okay, I'll start with a few general comments. And Murray, the headline, I think, on 10 is that I would urge you to be relatively patient. Channel 10, since 2004, the Channel 10 share price has fallen by 80%. It's been a really disastrous investment. And there's a view that the issue is a short-term slump in advertising conditions, but a fall like that over a time period like that is, I think, evidence of a much more fundamental issue. We think the problem is that at the end of the day, Channel 10 is a business with poor economics and very limited growth prospects. And it's a business that increasingly we think will face challenges from digital media and the proliferation of alternative channels vying for audience attention. So it's a business that has never met the sorts of quality and performance filters that we apply at the Montgomery Fund. And notwithstanding the share price fall of 80% since 2004, we think that the intrinsic value is still considerably lower than the current share price. So we don't think it looks cheap. We don't think it looks like a good business.
I think what he's trying to say is a dog with fleas. Tim, an investment case in Seven West, or are you guys, still steering clear of it?
Yeah, Kim, you asked, has that much value been destroyed? And our numbers say that the value wasn't there to begin with in the case of Seven West. Its intrinsic value has, for a long period of time, been significantly below the share price. It's now gotten to a point where the value seems to have reached the share price, so it's arguably a better prospect on that measure than Channel 10. For us, still not a business that we would invest in on the scaffold rating system. It's a B4, so it's outside the universe of things that we can own, and it's certainly not compelling value by any means.
So Murray, there you have it. If you want to get into the television business, your choice is Seven West Media. Don't worry about 10. Don't worry about 9. Perhaps he's better off trying to buy the ABC instead.
That is rating well.
It is rating.
It is rating very well.
Or go and invest in Macquarie Radio with Alan Jones, who doesn't have any advertising now. But anyway. All right, our next call is Kerry from WA. Welcome to the program, Kerry. Thanks for patiently holding on.
Yeah, thank you very much. We are holders of Aurora Gas and Oil and have been for about 10 years. Just want to know if it's a hold or should we sell?
Interesting question. That's one that's come up from time to time. What about you guys at Montgomery on this one? Have you had a look at it at all?
We have had a look at it. Kerry, at Montgomery, we don't own very many resources businesses at all. Aurora Oil and Gas is one that we do own. It's, as you know, it's an oil and gas exploration and production company based in North America. We own it because we see the potential, while it hasn't earned significant profits to date, we see the potential for very, very strong growth in earnings going forward. And it's one of a very small number of energy companies where we think the potential upside justifies the risk that's inherent in this sort of business.
This is in conventional and unconventional?
Yep. Kerry, to come to your question, we think that at these levels it's something to continue to own.
You. Okay. Anne from New South Wales is our next caller. Anne, welcome to the program.
Hi, Kim. Thanks for taking my call.
Not a problem. What question would you like to ask the panel, the experts?
I'm thinking about buying either Origin or Santos, and I wondered the panel's opinion on which of those they would choose, which they like best.
Good question. Tim, throw to you. What's the which one would you be going for, Origin or Santos, or both in that case, to make it an easy choice?
Are they the only three options? And I'm not sure I can, in good conscience, recommend either of these businesses. And there are a couple of reasons for that. One is neither of them in the last several years has earned a return on equity that is at or above its cost of equity. So the money that has been invested in these businesses hasn't been earning an economic return, and shareholder value has been destroyed. Cash flows for both of them over a long period of time don't look very appealing. It looks to me as though they both generated something close to a zero free cash flow, which reflects a high capital intensity, the need to constantly put money into the business, and an insufficient return being earned on that money. In terms of valuation, we have intrinsic valuations on both of these businesses, which is no more than half of the current share price. So I'm probably not the best person to ask for a recommendation on these ones, because I don't think either of them is sufficiently attractive to warrant investment.
I mean, the interesting thing about to get to a valuation that's only half of the share price, you must be using a pretty high discount rate.
We do use a reasonably conservative discount rate, particularly with resources-oriented businesses, and we do that because the risks in those businesses tend to be fairly high. And we're probably too punitive on resources companies, and we tend not to invest in very many of them. as a result, but that does reflect a view that quite often we think shareholders aren't sufficiently well rewarded for the risk that they take on in those sorts of businesses, so they need to be standout investment candidates to really get our attention.
We'll move on to our next caller, who's David from Victoria. Welcome to the program, David.
Oh, hi. Just wanted to ask the panel their opinion on Cedar Woods. I've noticed the company's fundamentals have always been pretty good, but lately they've paid down all their debt, and I think they look pretty good.
Yeah, interesting question. We've had a few about this one. We were talking about it a bit earlier about, you can see the prices had a bit of a run there from $3.60 to over $4. I would have thought this one might have popped up on your screen, Tim, because it does trade at a bit of a discount to NTA.
It has. This is a business that we have taken a little bit of an interest in recently. One thing that I'll note with it is that it has a share price of $3.80. In its last annual report, management disclosed their management's valuation of the assets in the business, so the land and the semi-completed projects. And their view was that at current market values, rather than the historical acquisition cost, which can be a lot lower, the net tangible assets of the business was around $5.35 from memory, so significantly above the current share price, which is a very encouraging sign. It has, since I think 2008, 2009, paid down all of its debt, which is a good sign, and it looks to be a surprisingly high-quality business. Property developers are the sort of business that we might normally be a bit wary of. This one seems to be performing very well. It's an A2. We think it has an intrinsic value significantly above its current share price, and with the support of that NTA backing, it does look like a business which is worth a closer look.
Our next caller is Steve from Victoria. Steve, welcome to the program. What question would you like to ask?
Yeah, hi. I was wondering your outlook for long-term of Slater and Gordon, and if you've got time in the reject shop also.
Okay, well, there's. Let's deal firstly with Slater and Gordon. Tim, is this one that pops up as a relative value stock?
It's one that does look like you can ascribe a value to it that is in excess of its share price. I'd probably agree with Jeremy's assessment, though, for a few reasons. The first one is that Slater and Gordon, it has grown its profits over the years from about $17 million in 2009 to $25 million in 2012. The issue is that EPS has been flat, and the reason for that is that they've been issuing shares as profits have grown. So as a shareholder, you haven't really seen the benefit of that growth in profit. And while I'm not too familiar with the business, it looks from the numbers on the screen like they have been issuing shares as consideration for acquisitions along the way, and what that has meant is that the business has grown in a way that hasn't benefited shareholders. IMF, as Jeremy suggested, is a business that we think is probably more attractive. It's a business that we own in the Montgomery fund, and it's one that requires probably a long-term view because it has the tendency to be very lumpy. Its cash flows and profits can swing quite wildly from year to year depending on its success in large cases. But if you take the view that you prefer, as Warren Buffett does, a lumpy 15% return to a smooth 12% return, then IMF may be a business that's worth looking at more closely.
So our first caller after the break is David. Welcome to the program, David.
Thank you.
What would you like to ask the panel?
I'd like to ask the panel's opinion on Roce Oil. I've been a holder for many years, and they've been up and down, mostly down, but they're starting to rally more recently with findings in the South China Sea. And I just wondered if any of the panel could give me any advice in that area.
Okay, we'll see if we can help you. First of all, Tim, this might be a short conversation that David's going to have with you. I suspect it might be.
You know me too well, Kim. Roce Oil's got a very patchy performance record. It's not a business that has passed our quality and performance filters, and so it's not one we've looked at. Intrinsic value, it does look as though it's close to intrinsic value, but for a business like this, we would want to see a much more compelling valuation than the one we see now.
Our next call is Philip. Welcome, Philip.
Good evening.
Evening.
I'd like to know about Ancient Technologies, please, HSN, and also a previous caller rang in about the reject shop, which you missed out giving some information on that, if you wouldn't mind, please, both as long-term investments.
All right, well, seeing that's our second caller on the reject stop, we better
You've only got to ask twice.
You've only got to ask twice. If you get asked 3 times, you'll probably get lynched. I know that you guys, Tim, have been in and out of this one a few times. So, what's the current prognosis on the reject shop?
The reject shop is one that we own at the moment, and we have owned for a while, and we bought more of on the back of the recent 2012 full-year result. The reject shop had a terrible run. It lost a distribution centre in Ipswich in the floods, and its business was really badly impacted for a period of time. They've now sort of rebuilt the infrastructure that they lost, and the business is recovering well. It's one that we think is really well managed. There's a long list of initiatives that reject shop management are always looking at with a view to improving the business, and we think they're very good at what they do. We also like it because, unusually for a retail business, it seems to have a level of immunity to structural change, in that the things that Reject Shop sells are too cheap to buy online and have couriered to your house. It has suffered a little bit in the more recent trading period because not many people have been shopping, and it depends a little bit on foot traffic to get people to its stores. But we think that, on the assumption that people will again start to shop, Reject Shop is a business which is positioned to benefit from that, and it's one that we're happy to own at the current price.
Okay. All right, Frank from Victoria is our next caller. Welcome to the program, Frank.
Hello, how are you?
Good, thank you.
I just have a comment to make and also a question to ask. I've been investing in the Australian stock market for the last 30 years. I've only been buying blue chip stocks and adding whenever I have some money. And today I'm very comfortable with the fully franked dividends that I receive, and I can live in retirement with that, without any problems. Now, the caller from Montgomery Funds, he said he doesn't like the banks, he doesn't like oil and gas, he doesn't like a lot of other West Farmers and a lot of other big companies. So he's restricting himself to only 10 or 15% of the market, which is a smaller end of the market. And then when they say you have to buy things like Oroton, which is a small company which they were promoting just a while ago, is down 50%. So can you tell me any of 2 or 3 stocks that he likes in the top 20 or 30 which have got so-called intrinsic value and which are good to buy at the moment?
Tim, you're on the spot.
I am on the spot, and in our defence, we weren't owners of Oroton when the share price fell. But Frank, to try and give a general answer to your question, we don't dislike big cap stocks. We don't like small cap stocks. What we do is we use software that values every business that's listed on the ASX, and we focus on the ones that look to be good value. And what you find quite often is that the best value is in smaller stocks. That tends to be the case because they don't get as much attention, as much analyst coverage as some of the bigger stocks. They don't have the big institutions pumping money into buying their shares. And you see more, what I call pricing errors, the market getting the price wrong, which means that they're an attractive opportunity for us. And we make no apologies for buying businesses that are good value rather than businesses that are big. At the moment, there aren't many big cap stocks that we're attracted to. We have owned Woolworths in the not too distant past. We have owned Westpac in the not too distant past. But at the moment, the valuations aren't enough to keep us in those stocks. To give you an example of some big ones that we do own, Seek is perhaps not one of the larger businesses out there, but it's one that we think has a really interesting long-term growth profile. And we own that one. Cochlear is one that we own in the Montgomery private fund. So there are some examples of larger businesses, provided they're high quality and they're good value. We're happy to own them. We won't own them just because they're big.
Though it's time to start Stockwatch. And it's Jeremy. What? No, it's Tim actually. Tim, what are you watching?
Jeremy did well last time.
Yeah, off you go. We always had him doing it again.
Nickel Express Offshore, ASX code MIO, which is a provider of service vessels to the offshore oil and gas industry. We like it for three reasons. One, it's got a modern fleet of vessels which has a good utilisation rate. Two, we think that the demand is going to be strong as a result of strong E&P capex in the next few years. And three, we don't think there's been enough investment in the offshore service vessel industry, which means that utilisation rates will go up, prices will go up, earnings should be strong in the next few years.
We'll take an email now, and one from Richard. Richard asks, he would be grateful if the panel could give an assessment of Challenger Limited on a medium to long-term basis. All right, interesting stock in the business of selling annuities, which is obviously been a good business to be in, given the fact that we've had such share market volatility and people have been leaving in droves going into term deposits and annuities. But we'll put Tim on the spot first because this is an interesting one. How do you guys actually, value this one, and what does it look like?
A few general points. First, as you noted, Kim, Challenger has been doing very well recently as a result of offering annuity products. And with the volatility that we've seen in the equity market, that has been a proposition that has been attractive to a lot of investors. I think it's unlikely that that's a permanent state of affairs. I think that if we see equity markets run strongly, then people will feel that the return they're making on annuities is not attractive, and certainly long term, I think investors do need to be exposed to the equity market to have a reasonable chance of long-term wealth accumulation. As to Challenger, it's not a business that we've looked at. The financial metrics that it haven't qualified it for closer scrutiny in our fund. But in terms of the valuation that Scaffold puts on it, it does look as though it is perhaps 10 to 15% undervalued at the moment. Although I would note that based on the forecasts that are available from brokers, we can't see the intrinsic value of Challenger rising over the next several years, and something that we would normally look for in any investment is increasing intrinsic value over time.
So our next one is from John, and John's asking us about Bluescope, and he's wondering, in the recent rally, whether we think it will slow down or pull back. CommSec is indicating high buyer amounts, large volume and a good price-earnings ratio. With this uptrend, would you look at selling any time, as I bought about 6 months ago at 36 cents? Wondering on the sale price target and your evaluations of the company. Well, yeah, this is a brave man that's that's decided that risk is part of his portfolio. Got into Bluescope, and he's actually made some money. So what should he be doing at these sorts of prices, given that we've got that takeover bid on the table for Arian? I imagine Bluescope's just got a big red cross against its name, and it's never going to get out from under that. So we might as well just sort of chuck it in the wastebasket and leave it there, eh?
Look, what I would say to the viewer is congratulations on your timing. There are not many people who are current owners of Bluescope who can claim to be in the black. But as Kim has suggested, it's not a business that we're attracted to. We think it's just a difficult business to be in, steelmaking in Australia, and there's clearly some interest following the bid for Arian by Steelmakers Australia, which is South Korea,
which is hard in Australia.
Not Australia at all.
Guys, let's move on quickly, because we've just got a couple of calls that we'll try and deal with. And sorry to cut you short there, Tim, but Jean from Victoria, welcome to the program, Jean.
Thank you. I'm wondering if the panel could give me their view on Adelaide Brighton, please.
There you go, Adelaide Brighton. Now that's a good fundamental. Tim?
Look, I agree. I like Adelaide Brighton for a building materials company. The fact that it has lime and a really, really strong market share in lime, I think, has been a great boost to it. Its intrinsic value has increased over time. At the moment, I think it's overvalued, so it's not something I'd invest in, but it has been a good building materials business.
Just very quickly, because we've got a little bit of time left, is there anything else left in the building materials sector that you'd be looking at?
No, there's nothing in the building materials space that we own at the moment, and probably the biggest issue for us is how do they get growth. A lot of these companies have reached a stage of market share where there's just not much scope for them to improve on their current position.
All right, perfect timing, gentlemen. So that's all we have time for today. So thanks very much to our guests, Tim Kelley from the Montgomery Fund and Jeremy Hook from TMS Capital. And to all you viewers, thank you very much for your calls and emails. Until next time, I'm Kim Slater. Have a great week.